Morning, good afternoon. Peter's got his coffee. I've got mine too. We're so thrilled that you're here. I'm Shane with B Ventures, and Peter, who we'll be asking some questions with today, who you'll also have the chance to ask some questions with, sits on one of the largest startup data sets in the world. We're talking over 50,000 startups. We're talking across 160 countries, and we're so honored, so lucky, and blessed to have him here. So the questions that maybe you're wrestling with and why you should be here is, should you even raise VC? Is it even worth it right now? And to everyone listening, I think this might just be the best hour of your life. Here we go. Peter, welcome to the podcast. So glad to have you here, man.
Best hour of your life is pretty strong. I want to set those expectations a little bit lower than that. But a good hour, sure. Yes, let's shoot for it.
Let's do it. Let's have a great hour, and we'll do it together. And to kick us off, I want to share just a couple quick housekeeping items. So, first 10, 15 minutes, I'm gonna ask Peter some questions that are all centered around you, the founder, and then the second part of this is you'll be able to ask your questions. So, I recommend jotting down some questions while he's talking, while he's sharing, and it could be questions about anything. And before we do that, a couple housekeeping items coming to you in the chat. First and foremost, this is being recorded, so don't worry about that. Yes, it's being recorded. That's the number one question we get. And also, we'll post it when it's live. Also, as well, the second thing before we get into the questions, Peter, please, please, please go check out Carta's launch platform. It's free. So create your account on there. When you do, you also get a 25% discount. It's only for the people who listen to this show. So
Nice.
please, please take advantage of that. Huge. And then, of course, follow Peter on LinkedIn because I have a hard time finding better content out there in the world than Peter's. All
Yes.
right, we've gassed him up enough, as if he needed it anymore. Peter, awesome to have you here. Are seeing things right now, my friend, that most founders don't. Founders are so busy selling, building, all the things. What's your number one piece of advice that you would give to a founder right now who's struggling to raise right off the bat?
Um, Look, I think that unfortunately applies to most founders. It can seem on social like everyone is raising massive rounds at high valuations and this is easy and AI has made everything simple. It really hasn't. In fact, I'd say probably the stress has increased over the last year or two when it comes to venture and venture-backed startups. But the first and maybe the sort of meta text across this entire conversation is, should you raise from VCs at all? Many, many, many founders should never talk to VCs. It is one pathway towards building a company and externally funding that company, but it is by no means the only pathway, and it is a very difficult one if you are not building what is likely to be a very massive business. So that first question you got to ask yourself is, am I trying to build a venture-backed company because I think it's cool, because I think it's what I have to do, or because it's what I actually believe. And you got to be pretty strong on that belief point before you get started.
So you recommend VC for those who want to build huge companies. Can you
Yes.
can you quantify huge?
Yeah, your company should be worth $1 billion or more.
And let's say everyone here, yes, I'm Peter 100%. I want to build a $1 billion company. This
Yep.
is why I'm here. Like you talk about deals, you talk about the capital formation right now. Like, what are the most important things someone should know before they go out and say, yeah, hey, I'm going to go raise VC?
Um, okay, so let's take it back. Many founders don't understand VC as a model, so maybe this is useful for you to think about it from the side of the investor. A VC is a very odd type of fund. They're a kind of a weird thing in finance. Um, you have to start from the fact that most startups fail. Most new ideas don't work out. I'd say if you want to paint some numbers on it, call it 9 out of 10. Pre-seed, it's probably higher than that. It's probably 9.5 out of 10 will fail. In a world where 9.5 out of 10 companies fail, the ones that succeed must be massive to outweigh the losses. So if you have so let's call it a 10, let's make this easy. If you have a $10 million venture fund, what you are shooting for, what you've promised your investors is at the end of the day, I will give you back $30 million. That's 3x what the original was, net of fees and expenses. So it actually needs to be about 35 or 40 million dollars that you create in terms of the company values, and then you'll give back 30 of that to the investors who invested into you. That is the world. So why do VCs care if you're huge? Because they know they're going to miss most of the time. And so you have to be a massive company in order to justify their initial investment. Um, that's what you need to go into it with you need to be a fund returner. You need to return the entirety of the capital of their fund with just your company if you're going to be super useful to them. And yeah, you can get acquired and like that helps. And there's small little exits along the way sometimes, but not really. They really want you to get a massive acquisition, an IPO, or some other massive form of liquidity. That's what they're looking for. The problem with venture is that it is really, really good at talking about itself. So it feels when you go online like venture capital is the only way to build a business because venture capital is incredibly good at marketing and there's natural checkpoints along the way. So for a bootstrapped company that doesn't raise any money, you don't really know how they're doing. Could be good, could be bad. The revenue's up, down, nobody really knows. With venture, you raise a seed round, and then 2 years later, you raise a Series A, and there's check-ins, and there's coverage, and there's media, and there's discussion of where you fit into this larger venture-backed ecosystem because there's a whole network of people that are dedicated to making those stories a little bit more prominent.
And you said the magical words or the letters IPO. IPO since 2021 have been down quite a bit.
Yeah.
What is the Carta data saying about IPOs in 2026?
I think that people, whenever you talk to bankers, if you talk to bankers in Q4, they're always like, man, next year is going to be so awesome in terms of IPOs. There's going to be so many. They said that last year. There were 31. That was better than the 14 or so the year before in terms of tech IPOs, but not great. It's not like some massive number. It's March 3rd. Have we had a tech IPO yet this year? No, not that you can remember, that's for sure. Right? So, really, when they say that IPOs are going to be great, they're counting on three companies: SpaceX, Anthropic, OpenAI. If any of those go public, it will be a fantastic year for IPOs because those are gigantic private companies. If they don't, and my bet today is that they won't, maybe SpaceX. I don't think the labs are going to go public this year. Then it'll be another middling year for IPOs and liquidity will be hard to come by.
So then what should founders do? Should they be building for an IPO? It sounds like those aren't existing, or should they be building for an
I
exit?
mean, if you're a pre-seed founder, your IPO is 15 years in the future, so you don't actually have to worry about it that much. Like whatever the IPO climate is today doesn't matter to you. You have decades of time before you're going to be playing at that stage. So you don't really need to concern yourself very much with IPOs. If you're a late stage founder, there's always a discussion of the window. The IPO window is open or the IPO window is closed. That is not, there's no like actual person opening or closing the window. What that means is the market sentiment around IPOs is good or the market sentiment is bad. Market sentiment right now, I got to be honest, for a lot of SaaS or core software companies, not that good. I mean, look at Figma. Figma last year IPO'd. They have an unbelievable business. They are growing faster than the vast majority of software companies. They are making real money. Dylan is an incredible founder. It is a stellar business by any real metric. Their stock is down 90% from their IPO price. Does that mean the window is closed? Not necessarily, but you better be a damn good business if you want to go out right now.
Can you dive deeper in that? All these founders right now are in the trenches. What is a damn good business other than just, great revenues? Like walk us
Yeah.
through.
I mean, if you're talking about like what is a damn good business in terms of the IPO bar, the sort of informal, there's no written down definition of what great looks like, but informally, you're talking about a business that is worth between 4 and 6 billion dollars, has revenues of over 500 million ARR, and is making money, growing 20 to 30% a year at that stage. That's good. That's actually not great, by the way. That's just good. Um, Anthropic grew 10x last year after growing 10x the year before and 10x the year before that. So that's what great is in terms of growth right now.
That's a high bar.
It's a ridiculous bar. It's a bar that literally no company in capitalism has ever hit before. So it's kind of weird to be, holding yourself to that standard. Unfortunately, if you're a founder looking to raise venture capital, I'm not saying every VC expects you to be anthropic, but they do see anthropic and say, okay, that's what fantastic looks like. So what used to be fantastic is now just pretty good. And what used to be good is now just okay. Because what is great got completely redefined over the last 2 years in terms of revenue growth.
So true, so true. And for those of you who just joined, just a quick room refresh. Peter runs the insights team at Carta. Hundreds of thousands of people across different platforms are tapping in. He's posting, he's sharing about trying to help founders make sense of what's going on in VC. So that's what we're doing. Jot down your questions. You can also just share them in the chat and we'll get to your questions. So I'll answer them here in a couple minutes. And also, if you just joined, I'm Shane, investor at B Ventures, also run a PEACETECH accelerator as well, kicking off here in a couple months, which we're so excited about to help companies raise money and get money and have a peaceful impact on the world. Peter, there's so much going on. There's so many things that we could talk about. A lot of the founders here, some who I've met and been so blessed to have conversations with, they're all over the world. They're spread out everywhere, and there are pre-seed deals happening in hundreds of cities.
Yep.
Can you walk us through the geography? And is there like a specific geography? Like,
Mm.
how do you approach that in your mind?
Yeah. I mean, there's definitely geographies, location matters in startups. Probably that's no surprise to any of you. if if we map out venture capital across the US, there are basically two hyper mature, developed, whatever you want to call them, ecosystems, which are the Bay Area and New York. And then there's a whole long list of places where you can get started. I actually think some people look at this dynamic and they say you have to move to San Francisco in order to raise venture capital. That's definitely not true. You can raise VC rounds, the beginning called pre-seed seed, in literally hundreds of places across the US. It has never been a better time to get started in many, many, many places. Charlotte, Dallas, Seattle, Austin, like all across. If you're going to raise major venture capital, if you're going to raise 50 million to 100 million dollars, you're probably going to talk to Bay Area investors. That's kind of how the dynamic works. The other thing is that there is sort of a concentration or a gravity to the Bay Area that doesn't really exist anywhere else in startups. Um, it's kind of akin to if you're an actor, you dream as a young kid of going to Hollywood. SF is the Hollywood of startups. It's a company town. Everyone is in tech, everyone is building their own thing. So your Uber driver before there was Waymo would talk to you about their app idea. Like that's the water that you're in. Doesn't mean you have to build there, but I do think it is a little different than most other places.
All right, so you can raise pre-seed, even seed where you are. It might be helpful as you go to get to the hubs. And also
Totally.
maybe if you're fintech, probably a dabble in New York because there's so much fintech going on there.
100%.
Or national security, probably DC or El Segundo. Like there are a lot of different places that you can tap into. How about there are also some wonderful friends here who some of them are solo founders, some of them
Yeah.
are co-founders. What does the data say about how top performing companies typically perform with the founder setup?
Yeah, we have a ton of data. We have the best data in the world on this, actually. So two things kind of really stand out from our founder ownership reporting. The first one is that solo founders are becoming more and more common. So more people are starting just alone. Pretty cool to see. You can, a ton of explanations for that. Cost of company creation is getting lower. With AI, you don't need a technical co-founder, all those things. So we had 36% of all the founders that joined Carta last year were solo founders. Awesome. By the way, if you're interested in solo founders, there's a sort of a group here in San Francisco called Solo Founders, the Solo Founders program. So if you go to solofounders.com, you can read a ton of data on solo founders and how they're building. Like, I love that group. They're awesome. Second point, though, solo founders, there's more of them than ever. They are not being funded by VCs at the same level. So VCs are still hesitant to back solo founders by and large. Um, they give a lot of reasons for that. Some of those reasons are, what if you get hit by a bus, which is stupid? Like that kind of stuff is, I think, silly. What they're actually saying when they say they don't want to back solo founders is one, they believe in complementary skill sets. So they think it's probably more likely that the business succeeds if there is a business and a technical founder is a very common startup trope. And the second is they kind of think you might be an asshole, and nobody wants to work with you, and that's why you don't have a co-founder. Without saying it, that's what they're asking. So you can totally start up as a solo. I think there's going to be more and more solos over time, but that's the general dynamic. And then if you have a co-founder, the next question is, well, what do you do with that co-founder? How do you split up the company at the very beginning?
Got it. Such great insights. And please keep posting and sharing the data on that you do as the years go on. It's so helpful. All right, let's
Yeah.
say all the boxes are checked. Donald, Rachel, etc., are in the meeting with the investor.
Yeah.
And let's make this practical. Like, what are some tips of things that a founder should say or not say in a meeting with a VC so they can progress?
I just wouldn't look at it that way at all. You're not trying to game a system to somehow get a VC to like unlock a cash register for you. You are looking for an actual partner. So if you're like, what is the perfect word? You've already lost. Um, what you need to do is, people get very mad at VCs because most VCs will pass on your business or not be interested in funding you. Um, First things first, don't take that personally. Uh, there are good VCs in the Valley that I know quite well who will see literally meet with between 800 and 1,200 companies this year. Meet with, not just review their decks. Are you in the top 1 to 6 of those 1,200 companies? That's what they're looking for. So it is not a personal thing to say, cool business, we're not going to fund it. I hope you do very well. They mean that. They're not being disingenuous. You just were maybe number 8 in a list where they only funded the top 5 out of 1,200, right? So, like, you just got to depersonalize this, number one. Number two, don't assume that feedback from VCs is useful or honest. It's not. They might say we passed because you're too small. They might say we passed because you weren't growing fast enough. They might say we passed because we already funded a company in this space. What they meant was we just didn't believe. And that's okay. Like they don't say that very often, but that's what they mean. The third thing, if you really want this meeting to go better, there is one foolproof way: grow faster. If you scratch a VC, underneath their shirt will be a big tattoo that says grow faster. Always. So if you're wondering why this meeting is going so slowly, if you were growing 5 times as quickly as you're growing now, I guarantee you the meeting would feel different. There is no world in VC where they don't appreciate growth. And that growth, obviously, if you're a software company, can be revenue, but it could be other things too, right? Traction, you can judge traction in a lot of different ways. But growing fast is the prerequisite to being a VC backable business. If you're building hardware or biotech, it's kind of difficult. You have a longer time horizon. But if you're building a software company, growth is not just the thing they care about most. It's the thing they have to see first before the rest of it makes sense to them.
It's almost like you have to be undeniably good.
Yep. And some VCs are very interested in credibility stamps. So where'd you go to school? Where'd you work before? Are you a spin out? You'll read about amazing rounds being raised by founders who actually don't even have a product yet. Most of the time it's because they're coming out of a research lab or they founded a company before. Like those people have already been stamped. So if you don't have stamps, what is your stamp? Your stamp is growth. That is the stamp that anybody in the world can give themselves. Whereas the other like credibility or sort of statusy things that matter, you can't always give yourself those things.
All right, before we wrap up, two more questions, and we'll open up to the audience here. Real quick, talking about Carta.
Yeah,
So can you lay it out for all of us here in the call? Let's say someone says, "Yes, I want to build a billion dollar company. I can do
yeah.
it. Yes, I want to grow fast, I can do it.
Yep.
So how can Carta actually help us
Yeah.
stay organized?
So Carta is for when we talk about founders, Carta is actually kind of two or three businesses, but the ones that actually deeply matter to founders is cap table management. So as you grow, if you're going to build a venture-backed business, two things happen. One, you'll almost certainly have teammates. Maybe you just have AI agents these days, but probably you're going to employ other people. You're going to give those people ownership in your business as a reward for their hard work and to keep them aligned to the long-term prospects of the company. You do that through Carta. So Carta is where you digitally issue your stock certificates to these employees. They can track their ownership. As you raise more money, they understand what's going on with their slice of the pie, et cetera, et cetera. It seems easy. It gets very complex when you have hundreds of employees that have different kinds of shares. And then you, again, bring in the investors. So the other reason why people love Carta is because investors, when you actually execute, call it a seed round or something like that, you can model what that does to your ownership on Carta before you sign it so that you're never surprised you didn't sell 50% of your business accidentally. You know exactly how this new money is going to impact the company that you're building. And investors love it too because it's clean and easy and modern, and they kind of expect you to be pretty good at the cap table management side. And we can help you with that. And we do it for free until you've raised $1 million. So that's pretty cool.
Fantastic. So basically, it's a way to stay organized. That way you can make informed decisions about if I give away this much equity, this is going to be my ownership. Okay.
Yep, exactly.
Okay. All right. Before we open up for questions, first, such great takes. Hot takes, warm takes, the best takes. What is a reason to be optimistic and positive about the future as a founder right now, Peter?
I mean, I think it would be kind of hard to not be optimistic just given the level of tooling and power available to you, especially if you were non-technical before, but even if you were technical, like this AI wave is democratizing access to what we would call, 10x engineering. So there's really no excuse now. Like it used to be the joke was if you were just an idea person, but you couldn't go execute, then ideas are just kind of worthless because you have a dozen of them all the time. That's no longer the case. You can go execute on your own ideas without involving anyone else. So I think it's actually absolutely it's a renaissance right now in how much you can build by yourself and how quickly you can get something into production that is actually meaningful and helps customers. So it's pretty incredible. Um, there's no time in my view where entrepreneurship is somehow diminished. I think the real question is what capital stack do you need to make this work? Um, Matching how much money you need and from whom to the business that you want to build, that's always where the conflict comes in. So just be very certain about what kind of business that you want. And some of that is the market that you're in, and some of that is what's your personal ambition, right? Those two things really matter. And if you find yourself saying, I just want to tinker around and build cool and interesting things that are not going to be very big, but they're incredibly useful to a small set of people, don't take venture. That's it.
That's right, one step at a time. All right, Donald, feel free to come off mute and ask your question. And just a framework, please, brevity. That way everyone can ask questions. And then of Peter, and then just say your name, your company, and then your question. And we'll take them one at a time. So Donald, go ahead.
Yeah, yeah. Thanks, Peter, for your time. I really appreciate it and the insights that you offered. I was just curious, you were talking about the IPOs, which got me thinking kind of about waterfall analysis. And do you think possibility, how often or common is it for a company that is building and seeking institutional investment, whether it's through family offices or venture capital? Like,
Mm,
how often is it till they get to the Series A growth stage until they receive venture funds? So,
yeah.
how common is it to get to a Series A level where they've bootstrapped completely on their own to build out? And then we're using the same kind of growth metrics in the venture, yeah, in venture. Yeah.
Totally. It's a great question. I would say it's not very common, but it's not as though they have to follow. We talk about things like pre-seed, seed, Series A, Series B as though they are checkpoints that you have to hit. You don't at all, right? These are just made up stages. You can skip all of them if you want, or you can skip a few, etc. What we don't see very often is that, first of all, the definition of a Series A in this case Currently, we see Series A as median raising about $10 million. So think of it between like if you're going to raise between 8 and 12 million bucks, how often is it that a company would start as their first round at 8 to 12 million? Not that common, probably less than 15% of the time. Does happen, and it certainly happens today more often than it ever has because of these, major businesses that are being spun out by repeat founders, and you kind of know that you're in that category if you're in that category, right? It's like a kind of a club in that way. If you're bootstrapping, I love the idea of bootstrapping and then raising venture at a later. I call this like late VC, where you don't raise pre-seed or seed or maybe even Series A, but you become my Atlassian is a great example of this. Mailchimp right before they went public, where they got to a pretty scaled business and then they raised 25 to 50 million in venture capital, and that was the first time they ever tapped it. It happens. It's just not very common.
Cool. Yeah. Well, no, thanks. I appreciate you your thoughts on it. Thanks.
Awesome, Donald. And Rachel, before we come to you, Peter, can you elaborate real quick on that? So why bootstrap then raise later? What's the advantage? You give away less equity of your company?
Yep, totally. And like people always ask, and I understand why they ask these questions of, okay, well, if I'm bootstrapping, why would I ever want VC, right? I just own the whole thing. It's so much better for me. I think it is almost always the case that if you had more money, could you grow faster, right? Can you put capital to work? If you are a founder, I think it's pretty rare to come across a founder who says, even if you gave me another million bucks, I don't know what I would do with it, right? That's pretty rare. So there's a question of how fast you want to grow. And in the case of companies who take VC late, they might be looking at it and going, we thought this was going to be a medium-sized business, but we see an opportunity right now to make it a massive business. And so we're going to pour fuel on that fire. The other thing, and this is happening a ton these days, is they're looking at the competitive environment and saying, look, if you've been following the stock market, public stocks are not very excited about SaaS right now. If you're a SaaS platform who didn't raise before, maybe you need to have a war chest at the moment because your competitors are getting really good really quickly. So there's a ton of reasons outside of my company's going to die tomorrow that you might want to raise money.
Awesome. Great answer. Rachel, I'll pass it over to you.
Thanks so much, Shane. Hi, Peter.
Hey,
Um, I'm curious about the pros and cons of an SPV. We
yeah.
do have early traction and some great market signals, and we're considering it as our next market or as our next fundraising move. And I'm curious what that looks like to VCs and the cap table.
Yeah. VCs are totally fine with SPVs.
Mhm.
SPVs, in this case, special purpose vehicles, also known as roll-ups. Basically, what you do in an SPV at this stage would be take a bunch of little checks, roll them up into one instrument, and then you have one line on the cap table that represents all those small checks instead of listing each individual person on the cap. Totally fine. I think candidly, they're a little like overblown. Like for instance, if you have 15 to 20 people on the cap table, like no VC is going to blink their eye at that. If you have 100, yeah, maybe it gets a little unwieldy and complex and an SPV makes sense. But generally speaking, VCs are good with it because they kind of expect cap table cleanup along the way. That happens very, very often. So I like it. And it's what it also does is it kind of aligns everyone on one set of terms. So you don't make individual deals where everybody's getting a slightly different set of rights and responsibilities. It's just here's the deal, you take it or you don't take it. You can fund it with 5,000, you can fund it with 50,000, whatever it is.
Beautiful. That context is super helpful. Thank you.
Yeah.
Awesome. What other questions? Yeah, go ahead, Andy.
Yeah, it's kind of maybe the opposite of the first question. One of the fears I've certainly had in startups over the years has been the fear of getting on the VC hamster wheel and not being able to
Mhm.
get off of it. And I was I'm in Chicago. Rachel and I are co-founders, and recently heard from Christina Chappell at 11 Tribes, and uh, she was talking about seed strapping as a new
Yeah.
concept. So it's kind of the opposite, where maybe you just do a pre-seed and a seed, and then you're good. You're off to the races. Are you seeing that too?
Yes, lots of companies are trying it. There are two problems with seed strapping. or not problems, but there are two complications. Uh, Number one, most VCs, no matter what they say, they're not interested in seed-strapped companies. Now, this seems silly, right? Because if you're the only investor, that means your shares are not going to get diluted. So why wouldn't you love a seed-strapped company? It's because they don't have anything to show to their LPs. So if you're a venture investor, what you want, what you really want, is to invest at an early stage company and then watch them grow very quickly and then raise their next round. Then you get to mark up that company at a new valuation and show your limited partners, oh, look how good we are. We got in first. If you seed strap, there's no markup. You just don't know. Now, yes, of course, you can report on revenue growth and all that stuff, and you do, but it's not the same. It's not the same as a markup in their fund. And that's not what they promised their LPs. So there are VCs who are great at seed strapping. Bryce Roberts at Indie VC is probably my favorite seed strapping VC. You'll see on his website, he says the last capital you'll ever need. He's very explicit about that. He did not raise from typical LPs from venture. He raised from different people and he promised them different things. And so that alignment is really clear with his fund. The vast majority of VCs are not interested in that. So they might say, cool, let's do it. And then a year later, they'll go back and say, like, hey, Andy, y'all thought about raising a Series A? You should really raise a Series A. That's one. The second problem, many founders will get on the seed strapped path and then they will go, you know what? Sounds pretty good. A Series A. So it's actually both ways that I see it. I think it's awesome to be, if I'm being completely frank, I think the best way to do this kind of seed strap model is to do it from angels, not from institutional VCs. So if you can raise between 500K and $1 million from angels, there's just like a lot less pressure from people who are not beholden to other people's capital. So if you can do it that way, I think that's probably the best way to do it. Not easy though.
Cool. Thank you.
Yeah.
And Peter, how about bridge rounds right now? What are you seeing in bridge rounds? Are they smart, unwise? What is a bridge round? If you could explain that.
Yeah. So as you get into venture, there's basically two delineations between the fundraisers that you might come across. One is primary round. So I raised a seed round. I raised a Series A. Big rounds, good amount of money, like stakes in the ground. In between those rounds, you can raise what's called bridges or extensions. So it's not, if you raise a Series A, it's not that you're raising a Series B. It might be that you're raising a Series A extension or a Series A preferred 2. There's like 1,000 names for them. A little bit more money to get you to the next round. That founders, I'm not saying that you should never raise one. Like the world is hard. Your plans might be off. Totally, I get it. You should never be trying to raise one. I see a lot of founders these days who are explicitly in their plan saying, we'll take this Series A and then we'll probably go back for an extension before our B. Don't do that. The money might not be there. There's no requirement that your current investors double down and give you more money. They never have to. And if you look at it from an investor perspective, bridges are usually wastes of money. Imagine you're a VC. It's already likely that 9 out of 10 of your bets are going to fail. And then one of the companies you invested in is like, oh, yeah, we're not doing very well. Can you give us more capital?
Yeah.
Is that a good bet? No, it's not. I
It,
think bridges work out about 3 times less than unbridged companies.
wow, that's a great insight. I mean, assuming you're aligned with the investor, values are there, et cetera, everything's there. Brian is at B Ventures, we're constantly talking about like, hey, if you have the money from this investor, like grab it. Why plan for a bridge round when you can just knock it all out, let's say, in your
Yeah.
seed or your Series A?
I mean, you're bringing up the hardest question in venture, which is how much money should I raise? It is very difficult to know that. Uh, there's 100 factors that go into that. And there's two schools of thought in founders, and they're both right. And it's annoying because they're in direct conflict, where some founders are like, raise only the amount of money you need down to the dollar. And some founders are raise as much money as you possibly can because you don't know when you're going to need it. And both of them are right. And it's really hard. It's a multivariate equation. It's very difficult.
Yeah, it's hard, but you go anyways. You take imperfect action. There's a
100%.
question. There's a question from Donald. Is there an uptick right now in hardware, software investments, dual use? Um,
Definitely.
yeah. What do you?
Definitely. There's a lot of VCs who are wondering whether or not their software businesses that they've invested in are dying, or have no moats and are going to get competed down to nothing. So hardware itself is definitely up, and then hardware dual like strategy, hardware software combinations, hybrids, also exciting to VCs. I don't know if there's a lot of VCs who are super good at investing in that. Do you want to be your VC's very first hardware investment? Maybe. Like, I don't know how helpful they're going to be to you, but they're looking for it for sure.
Definitely. I mean, you mentioned moat, and I'm thinking about like in software right now, a big focus, what I'm hearing from a lot of VCs is like they're sort of pausing a little bit and contemplating before making AI pure plays if there isn't like distribution or something unique about your technology
Yeah.
or an edge. Like really having that down pat is powerful when you're talking to VCs for sure.
You need to, I mean, if I'm a founder these days and I'm walking into a VC meeting, I am explicitly calling out why Claude is not going to eat this business in 6 months. Like, that is on their minds. You should have a great answer to that question. Why will the foundational models or other AI companies not be able to recreate this technology or this edge very easily? Um, and part of that, I think so that sounds depressing, right? Because you're like, well, Anthropic could do whatever they want. The model just keeps getting better and better. Um, I think that there's also sort of a tendency for the very online among us and the people who are super clued into startup world to just kind of overreact to whatever happened yesterday. Um, Cursor is a great example. People, Cursor is this coding business. It's gigantic now. It's growing incredibly quickly. And then everyone started using Claude Code and Codex, and there was just a ton of stories online. It's like, oh, Cursor's going to die. It's got no chance. It's actually growing faster now than it ever has. Um, the like Sometimes the moat is that the market is massive, and we're just at the very beginning of it. So even if you capture a small share of that market, if the market is expanding, it can be an incredible business. Sometimes that's the moat. But people are definitely asking. People are asking more than they have before.
Yeah, very true. Any more questions before we wrap up? Peter, this has been so good, so fruitful. There's so many good takes. I'm gonna summarize a couple things you said here before we go. You said call out why Claude cannot copy you or copy
Right.
this. I think it's so powerful. You talked about growing faster, and that really stuck with me. And then also, more founders are starting alone. Like AI is a great unlock for founders today. If you had to leave us with any parting wisdom or parting advice of maybe some things that we didn't cover, what would you share?
I think the biggest problem that I see with venture-backed founders in particular these days has nothing to do with the market. The market's always crazy. You can't control it. It has to do with their own personal like feelings about themselves. Try as much as possible to separate the valuation of your company with your sense of self-worth. It's not easy to do, but you get a lot of problems when like you consider yourself one kind of person when you're valued at 100 million and a completely worthless kind of person if you were valued at 50. It's That's just not the case. So try as much as possible to emotionally disentangle these two things.
That's good. That's good. One final one. Andy said, any opinions, Peter, on weaving crowd equity into cap tables?
I gotta be honest, I don't like crowd equity at all. I think it's a completely different business model from venture. It's awesome if you're like, go do a Kickstarter if that's the thing that you want to do, but mixing that into venture back, like VCs are not excited about that. No.
Well said. All right. There are a lot of approaches. I would invite you. Yeah, I agree. It's great advice. You've been listening to an awesome conversation with Peter today. I would invite you take all of or even take a small piece of what Peter shared and apply it to your life or even an adjacent idea to what he shared. Apply it to your company, apply it to your startup, your own deals, your own conversations. with VCs. And lastly, as we close, so wonderful to be with you all. Carta has a special offer just for the PeaceTech community here in the chat that will allow you to create a free Carta account so you can play around with it and see how you like it. Of course, if you have questions, you can DM me on LinkedIn or email. And then also check out Peter's LinkedIn. So cool. I honestly don't know how you do it, Peter, with the charts and the graphs and the design and the copy. It's incredible and it's an inspiration. And there's such good content on there. And even if you're just like hanging out on the weekend, it's go back and look at Peter's previous posts and sort of get a feel of like if you're raising your pre-seed, he has posts specifically on pre-seed that I would really tune into as well. And then also, last but not least, Carta and the accelerator are teaming up. So there's already a wait list for the accelerator. The link to apply when you want to get more information is also the third bullet in the chat. So grateful for each and every one of you. And can we give some love for Peter Walker from Carta? Thank you, Peter.
Thank you,
Cheers, y'all.
Peter.
Good to spend some
Thank
time with
you.
you.
Cheers. All right. See you. Goodbye, everyone.
Later.
Cheers.
Bye bye.